Welcome to the Sirius report. This is Paul, and I'm very pleased to say today that I welcome Paul, who's obviously a good friend of Lisa and I. And obviously, Paul actually is one of the few people on X who actually works with assets under management, unlike a lot of them who pretend to do so. And it's always a pleasure when we get together and have a discussion about points of interest to do with the economy, financial system, etc. So, welcome, Paul. And thanks very much for joining us today.
Hello. Thanks again. It's always my pleasure.
Yeah. So, would you like to give people a bit of a background as to what you do?
Yeah, sure. So, uh, at by now, I have a bunch of different involvements in different businesses, but like the main one is this asset management business where I'm a partner, and we're pretty small by the standards of the industry. I mean, it's a huge industry. And I guess you could describe us as a multifamily office. I think that's the closest description to what we do. So we mainly deal with high nets, corporates, families, things like that. So not retail, although um, we are planning to launch a retail fund as well, but it's still in the works. So that's us.
Well, thank you. It's always good just to give people, I think, a bit of perspective as to what you do. So you are, as I said on X, at the coalface end of operations. So you have a far greater appreciation of what we're discussing than most people. So obviously, to anyone who's listening, we always come up with some plans, sort of broad ideas, what we want to discuss. And Paul sent me very kindly a list, and he referred to something as Besant's triple three plan. Obviously, if anyone who doesn't know who Scott Bessant is, he's obviously was a hedge fund manager until he had to dissolve all his assets and became the US Treasury Secretary. So I guess we can start with that.
Yeah, they refer to his plan as three arrows, and I guess it's a reference to a Japanese plan some time ago. They had like three arrows too, but when they say arrows, it kind of sounds like these are weapons, but to me, they're more like targets that they're trying to pursue. So the first one, and I guess the most important one, is to reduce the deficit to 3% of GDP by 2028. So literally by the end, by the final year of current administration. Um, it's funny, but it reminded me of 5-year plans in the USSR, which didn't really work. But they had these kind of ideas as well. So this is the most important one, and it's the most difficult one, I think, for the administration. The odds are against it. The House has just passed a bill that prolongs tax cuts initially implemented by Trump, and it looks like the debt ceiling will be increased as well. So if you keep taxes low, obviously it impacts the receipt side of the balance sheet of the U.S. government, and um, the question becomes, can U.S. earn more money to decrease the deficit? Can they increase the receipts, the revenue? And I guess the plan is to do this through raising tariffs. We still don't know what kind of tariffs there will be. Trump keeps coming out and saying that they're still on, but I think it's very difficult to implement these without some sort of retaliation. So trading partners are likely to retaliate. And I think that's part of the reason why the focus is more on Mexico and Canada, because these countries are obviously easier to influence than, say, China. And China has been like the assumed tariffs are lower, so 10% against 25%. But there's less talk about China, and I think the reason is because China is so important for U.S. in terms of logistics, in terms of goods that U.S. gets from China, and it's super easy for China to retaliate, basically. I would also say that U.S. demand for certain foreign goods is systemic and kind of impossible to replace. So, you know, the Canadian imports of heavy crude is a good example of that. It's very hard to replace that. And actually, if you look at the trade components of exports imports of Canada and U.S., you'll see that oil is the bigger chunk of it, and without oil, Canada is actually in deficit. So it's pretty critical. I would also say that it's difficult to implement these tariffs because they're likely to be very, very inflationary. We see this in in all sorts of reports from the industry. You know, inflation expectations are spiking. A lot of businesses in the U.S. are saying that it's very difficult to predict the future and invest accordingly. So I'm pretty sure there could be some hoarding of goods because of impending tariffs. So kind of difficult. I mentioned the taxes already. And the interesting part about taxation is that corporate tax is actually not the biggest chunk of receipts. It's personal income tax that is way bigger. So even if so the impact of that is kind of negligible, I guess, and it's more of a longer term proposition. So it's the point I'm making is that it's pretty difficult to increase the receipts. I guess pushing financial assets higher could bring in capital gain tax, but given where we are, in terms of valuations, I guess it's not that easy. And also, I've read only today that Trump is planning to go back on the tax agreement with China, which is very likely to drive Chinese from U.S. Financial assets, for instance. So there are implications like that as well. I guess it's really down to if you're serious about bringing the deficit down, I think it's really down to spending cuts, and that's why Elon Musk is there tweeting daily about how he's saved this and that. There's a lot of debate about how much he's actually cutting. He seems to exaggerate a little bit, but that's the push. I think it's important to remember that most of these government spending cuts would need broad political support and formal adoptions in Congress. So it can't be just Trump saying we'll do this so that it has to be passed. We know that the Congress is predominantly Republican, but the margins are pretty slim. So, for instance, the recent bill that passed in the House, most Republicans voted for it. One guy voted against it, but it was like literally a few votes apart, right? So it's not as easy. There are plenty of Republicans that that will be against it, I guess. So it's not just what Trump wants, what Musk does. It's also the political support that is needed. For now, these savings are not working at all. We've seen numbers for last quarter of last year, and they're pretty bad. The deficit has increased by, I think it was something like 300 billion. So obviously there is a lag. Obviously it's Biden's admin and their work that has led to it. So it's it's a good idea, but in practice we see the deficit growing for now, at least. Recently, as recent as last week, I think we had this major drop in GDP now estimates by Atlanta Fed. It's negative. It's minus 1.5, I think, percent of expectations for first quarter of 25. And if you think that GDP is going down, which is very likely because a lot of what has kept GDP positive in 24 was government spending. Essentially, it was government spending that kept it positive. So if it goes down, historically, recessions or, economic slowdown, it has led to widening of the deficits, right? So it's around 6% of GDP right now, the budget deficit, I mean. And if we see recession or something like this, or just a slowdown, it's likely to spike rather than go the other way, rather than go the other way around. So, a lot of skepticism. We're still projected to have these massive deficits for 25 at least. I guess, and I guess this is, the biggest contradiction in Bassen's plan, because he wants to reduce the deficits as a percent of GDP, but at the same time, his second kind of part of the plan is to stimulate growth, and he wants real GDP to be at 3%. So real GDP is obviously adjusted for inflation. So, you have tariffs that are kind of inflationary, and you have cuts in government spending that are negative for GDP. So his second part of the plan is very difficult to achieve in this kind of situation, I think. I guess deregulation could help a little bit, but to what extent is really difficult to understand. And like for instance, the oil thing. Trump wants to deregulate the industry, and he assumes that oil companies will come and drill, but that's not how the real world works. These guys need to be motivated to drill, and nothing motivates them to drill like an increase in the oil price, right? And and so it's kind of like I would say all these ideas are conflicting between each other, among each other. So I think a lot of it, the growth part of it, a lot of it was based on this belief that AI and machine learning could lead to productivity gains, and as a consequence to earnings for corporates. Well, it looks less and less likely with every day. These things seem to be unproductive per se. Maybe given a long runway, they could be productive, but not this year, not next year. This interaction of GDP targets and deficit cuts, it's a huge contradiction for me. I don't see how they align together, to be fair. And the third one um, is to do with oil, and they want to increase oil production by 3 million barrels of oil per day. So oil, we've covered this a bunch of times with you, but it's a very specific industry. It's understandable why they are kind of targeting oil because it's very correlated to CPI, the Consumer Inflation Index. And it's no wonder, given how big, how important it is in the global economy. So I guess you do the tariffs and increase inflation that way, but then you influence the oil price and push it lower, and this is kind of deflationary. So I think that's the plan. But the problem with this plan is that U.S. production is pretty high as it is. I think we're at around 13, 14 million barrels per day right now. And, its production has been going up significantly during Biden's term. It was only 10.7 in 2020. After COVID, it's 13 and a half now. So Trump's high was 13 million barrels per day, and that was just before COVID. So we're pretty high, and it's a question like, can they increase their own, shale production by another 3 million? I have my doubts, especially with these prices, with current prices for WTI. I don't think it's something that would happen just because of the regulation. There's another question of depletion of shale basins. They seem to be on a kind of a plateau, and Permian is the big one, and it's kind of flat. It's a big debate among oil analysts and investors about how much oil there really is to drill. And 3 million barrels, it's not that much. We're at 104 million barrels of global demand daily. So that's around 3% of total oil supply. It's the marginal barrel that matters. But I don't think it's the kind of change that influences the price that much, especially if this extra supply comes over time, the petroleum reserve has been going up in US. They've been buying, not that much, maybe 40, 45 million barrels from the lows, but they're not selling, so there's no way to impact the price that way. I don't think they'll be reducing it anytime soon. I guess the most important issue with oil is that there are different grades of oil. So, heavy oil, light crudes, and US produces light crude mainly. Even at current levels, which the administration sees as high, domestic refineries don't have capacity to process excess oil. So that stuff goes somewhere else, because a lot of refineries are kind of designed to use heavy crude, the stuff they get from Canada, the stuff they get from Venezuela and elsewhere. So heavy crude is important. It's used for diesel. So trucks and trains, logistics, very important. I would say essential for a productive economy. So and of course, just like with tariffs, OPEC Plus is not going to be sitting and just looking at US dumping the price, right? Saudi Arabia needs around $90 on WTI to balance their books, mainly because they have these ambitious plans for their economy. you could, I guess you could get Venezuela to produce more, but it's kind of a multi-year proposition. I don't think their current excess capacity is that big, maybe 300K extra per day, maybe 400. So, and it's interesting, but Bassent also said that he wants to bring Iran's oil production to 100,000 a day, from 3.2 million per day today. And, how would that lead to lower prices? It, it would lead to a price spike rather than, prices going down. Um, I think it's a good plan on paper, but when you get down to these technicalities, they're very conflicting. They're very, you know, um, kind of you push one thing and you get feedback on the other thing. And again, I want to stress this, but the idea that you're reducing government spending and you increase GDP is just ridiculous. I mean, that's not how it works, and it can't work basically. So something's got to give. I guess the productivity miracle is the big one that we're missing. What do you think? What's your take?
Yeah, where do I start? Well, I mean, what I would say is, and I share your sentiment, I think Besson's plan is a massive contradictions. I put something out on YouTube a while back talking about why things are mathematically impossible. I do like you're saying when everything boils ultimately down to maths, and it's true. Uh, with regards to tariffs for me, and I've made some very blunt statement on X about it, that in reality it's one of those idiotic policy decisions because it is going to be inflationary for the United States. And when you hear statements from Trump going, well, I'm going to put 25% tariffs on copper imports, well, because he wants to encourage the US to produce more copper, well, produce more copper first and phase out the imports. Otherwise, everything that you have to utilize copper in, which is obviously going to relate to production, is going to cause producer price inflation that causes, as a secondary effect, CPI, because whatever you manufacture with copper then has to go into some component somewhere else. And these are just very straightforward, obvious issues that it's one of those things. I understand why the United States wants to have an internal market to produce goods. It should have done it a long time ago. But you can't just have this situation where the answer is, I'm going to put tariffs on, and magically, you can go into the local shop and start to mass produce things domestically. It takes years, maybe a decade. And the other thing is, there's all this fear amongst countries of having tariffs put on them. Well, the United States is not going to easily find alternatives to go and buy those goods. So don't worry about it. Just sell the goods at the price you were selling them at. Let the United States internally have to suck up the 25%, 10%, 30%, whatever it is. That's going to be inflationary for the US. It's not good for its economy. And don't put retaliatory tariffs on, because otherwise you're going to end up with 25, 30% increases in goods or whatever you import from the United States. Just ignore it. It's just one of those strange things. I don't understand why everyone seems to get so bent out of shape about it. Let the US suck it up, because in the end, and for the foreseeable future, it's going to boomerang and cause them enormous problems. With regards to government spending, yeah, it's very laudable, but there's clearly already big holes in savings that have been claimed, and they're a fraction of what the claim actually was. And if you look at government spending, the obvious place to do it would be defense spending, and they've talked about slashing it by 50%, which if they did, that would be an enormous saving. But the Russians and the Chinese must agree to this, and Putin said, well, yeah, I might be considering this as a possibility. If we all do it and the Chinese are gone, we're not doing it. So forget it's not happening. So, okay, it may still happen, but a lot of this is just skirting around the edges of what the fundamental problem is. And also, it's one thing saying we're going to have huge tax cuts, 4.5 trillion, but we're going to reduce government spending by 2 trillion. The simple maths is, and okay, we have to be careful. We're not oversimplifying a complicated problem. In the long term, that's going to increase deficit. Huge amounts or far too higher amount of US GDP is just government spending. Well, if you slash that, you slash the GDP. So, again, it's all very laudable, but in simple terms, the maths doesn't add up. And coming out with figures about real GDP growth all sounds very laudable. But at the end of the day, if you're making all these contradictory policy decisions that actually impacts real growth, and you want to, yes, reindustrialize the United States, great. Well, who's going to finance that? You're going to have to spend trillions on infrastructure. You're going to have to try and make your internal market competitive, because it's no good saying, well, we don't want you to buy a widget from China for $10. Oh, buy the widget from us in the United States and it costs $30. The American people are going to go, and you must be joking. So
It's a better widget. That's why.
But it sounds like I'm oversimplifying things, but I'm not. I'm just reducing it to what is a reality. And yes, they thought, well, we can have this huge growth in terms of AI, machine learning. And then the Chinese rather sort of dropped a bombshell with regards to that. And the other thing is, of course, no one's looking at this AI revolution going, well, how many jobs is that going to go? What, 20%? I mean, there's a lot of outrageous claims like 50%. I don't know in reality what it will be, but it's going to be huge. So, and really, as ever, like the dot-com revolution, I remember that very well. And there's a lot of ridiculous promises made, and it turned out to be utter nonsense. And trillions of dollars of capital was just burnt with no obvious return on the investment, except speculators who sold companies at ridiculously high valuation and made lots of money. In terms of oil production, yeah, again, sounds great to increase oil production. But the problem is the US, I think, personally is peaked. In terms of its oil production, I think, all the low-hanging fruit is long gone in the Permian Basin. I think it's going to get more and more challenging. And as you rightly said, Paul, it's going to cost an awful lot more to extract the oil. And these companies saying, well, we'll remove regulation, to go, look, we got burned badly quite a few years ago, and hundreds of trillions of dollars got wasted. We're not going to go through that again. And we need oil prices much higher this time. And Trump's going, I want oil prices much lower. And, they've had this running battle with OPEC Plus throughout the Biden administration, and they won't defeat OPEC Plus. That's primarily, obviously, Saudi and Russia. And they're not going to defeat them. So, and then saying, well, we're going to increase oil production. And in the same breath, we're going to slash Iran's oil production. It's just, again, the maths fails. So I think it's one of those things, it all seems very laudable. And, I would applaud the United States slashing government spending if it's possible, but not in areas where government spending is needed. But when you add all these things together, it's like saying, well, we can have all these cuts, and at the same time, we're going to have massive increase in domestic reindustrialization. We're going to simultaneously slash all the imports. It's trying to make all these things work together. You can't. It's not possible. There's going to be a long period of trying to phase things in and phase things out. And for me, my experience, Americans are very impatient. They want everything yesterday, and they don't want any excuses why that's not possible, even though, of course, it's humanly impossible. I've had too much experience of explaining to Americans why something's impossible. I'm insisting we're doing it. And then a year later, you've burnt enormous amounts of capital. And of course, it never happened. And then you have to point that out to them. And then it's repeat and rinse. They keep making the same mistakes because they're very impatient And this is one of those things you need patience. And if the US economy gets hammered because of this, then, because of the ridiculous way the US electoral system works, in less than 2 years, in November of 2026, Trump could become a lame duck president because the House and the Senate belongs to the Democrats because people vote with their feet and go, well, you've trashed the economy because of your policy decisions, even though the US economy is far weaker than conventional wisdom suggests. So for me, I think, I would applaud the need for radical changes, but I just think the strategy is depending on so many things happening simultaneously. And it's not humanly possible to do this, so the maths doesn't stack up. And therefore, you can see huge problems going forward in trying to implement this. And, and at the end of the day, you need to have big line items to slash spending. So good luck telling the military industrial complex, we're slashing your gravy train by $450 billion a year. I'm not sure they're going to be too happy with this. And the other problem with the deregulation is a lot of this relates to Wall Street, because first time around Trump 1.0, Wall Street was terrified of Trump being elected. I remember the initial reaction was horror and markets got smashed. This time around, markets thought it was a great idea because the Trump administration's promised deregulation. Well, we all know what deregulation will do to the financial system, and in the broader sense, what it will do to economies. And just a final point you make, thing of inflating assets. Well, these asset bubbles should have burst a long time ago. If you try and inflate them anymore, then you're just going to increase the recipe for huge problems when, eventually gravity is going to take effect, financialization is going to fail. And if you want these BESS policies to succeed, you're going to also have to accept financialization as it is comes to an end. Well, good luck convincing Wall Street that, the gravy train they've had since 2008 is over. If you don't have the support of Wall Street in the US, you're going to have enormous problems. So I think there's many, many challenges here, and it shouldn't be just overlooked as this trivial exercise in just, closing one door and opening another, and it all magically hangs together, because, we could talk for hours and days about it. It just isn't reality.
Yeah. It's almost as if they want to collapse the economy, with these policies. And it sounds bizarre, but it would actually open the door for more stimulus, more money printing. And um, I think the beef that Trump's team has with the previous administration is not that they're spending and that they're borrowing. I mean, Trump is a debt guy, right? I mean, he loves debt. I think the beef is that it's been hugely unproductive. And I mean, it's true. If you look at the amount of that the debt has increased and the deficits have increased, and then you compare these numbers to the increase in GDP. In nominal terms, you'll see that it's been very, very unproductive, and it's actually accelerating. So last quarter was probably the worst, dollar to dollar kind of comparison ever. So it's like if you don't do anything, this thing just becomes increasingly less and less productive. And I think, I like the fact that they realize there is a problem, because the previous administration was telling us that everything is dandy, nothing to worry about, kind of thing. These guys, at least they're trying, and it's like with the Alcoholics Anonymous. I mean, the first step is to acknowledge you're an alcoholic before you can, start recovering. So it's similar to this for me. In terms of defense spending, yeah, it seems like the stuff that can be cut, if you're realistic about it, is probably the interest rate expense and the defense budget. Um, so, you low rates, and, you could save some money there, I guess, and you could cut expenditure that is predominantly foreign expenditure. I don't think it's a coincidence that Trump's rule started with cutting, all these USAID, NAD stuff, because it's something that your average American supports, basically. They'd rather have this money invested in their infrastructure or, bridges or something like that in their economy, than it being, given away pretty much. The Ukraine thing is similar, right? I think it has a lot of support internally, not 100% support, but a lot of people want this expenditure to stop. But even, even if you assume that defense budget is cut in half, so it's what, around 1 trillion, right? So say it's half a trillion saving, it's still not fixing the deficit. It's still a deficit, because we're running at 2.5, 3. If recession comes, maybe 4 trillion. So, it doesn't solve it really. But it's a step in the right direction. So the beef is with less of, with no productivity, I think. I don't think anyone, and well, definitely not Besant, they don't. I don't think they can believe that the budget deficit is going to evaporate for some magical reason. I think what they're saying is we need to spend better. We need to spend on productive things rather than these no end kind of expenditures that go who knows where. You know, so like yourself, I do think it's the right push. But you look at these ideas and they contradict each other. That's the problem for me. And and the same with like the monetary policy. Bassent is known for criticizing Yellen, and I mean I'm not a fan of Yellen. I mean I've been very vocal about this. But he continues with her policies not because he's dumb, or she was dumb, but because it's the reality of current, demand supply situation in the U.S. Treasury market. There's just not enough demand on the long end, and you have to stimulate, motivate that demand somehow, or create this demand. And for now, he just continues with Yellen's policies. By the way, late last week, we saw a huge decrease in the Treasury General account, which is, the account where government money is placed. And it was like, I think it was like 200 billion in 3 days or something like that. Some crazy numbers. So there's no magic fix. It's a long process. I don't think that one electoral cycle is enough for these changes, and the kind of changes that Trump wants, they involve high level agreements globally. So I would say that the chances of another Bretton Woods or Plaza Accord or something like that are rising by the day, and I think we'll end up with this uh, pretty soon, precisely because of the electoral system in U.S. So Trump has got 2 years basically, probably not even that. So they'll try to push all these policies in the year 1 or 2. But yeah, so we'll see. Maybe they're doing all of this for a reason. Maybe there's some logic to this chaos.
Well, you'd like to think so. I think the points I'd add to what you said is Besant made an interesting statement recently where he talked about the economy becoming Trump's economy in 6 to 12 months. So your assessment, they may be looking to crash things sooner. has validity on that basis, because they can say, look, things crashed. It's not our fault. This is a hangover from the Biden administration, and they'll get away with that, frankly. And to be honest, to a large extent, that's fair enough. So that could be something that's factored into their thinking. The other thing I would say, yes, the political system in the US is a joke. It's designed not to allow anyone, excuse me, to make policy decisions that are long term, 5 year, 10 year, whatever plans. So the argument is he's going to have to take the American people on a painful journey. I think, and I'm speculating completely here, the plan might be, well, we'll have Trump for one term, obviously, because he can't do two. Then maybe get Vance in for 2 terms. Well, we've got 10 years. And maybe in 10 years, and that's reasonable, we can start to make some real progress. And the American people will see the benefits, and then maybe it's not exactly continuity of government, because it doesn't work like that in the US, but to some extent, you may be able to leverage that argument. So I think that might be part of the thinking as well. But these are all incredible. I wouldn't like to use the word gambles, but they're incredibly challenging. And it's admirable and laudable to be able to think you can do this, but you're absolutely right. I think it's going to have to be a situation where you're going to have to get some major players to sit down and reach some sort of agreement. Well, I think the Chinese might drive a very hard bargain to make that happen. And then from their position, their attitude is, well, everything's going fine, contrary to conventional wisdom. China's economy is doing very well. It's transitional. We're not talking about China today, but yes, there are challenges, but they don't really need to sit there and go, well, we backstopped you in 2008, and then you kind of stabbed us in the back when you went and decided to go on a QE zero interest rate policy frenzy, which we weren't very happy about. So what are you going to give us this time around? Well, Trump's already sort of talked to the Chinese and went, we could have a G2, you and I, us and China, we can kind of be the hegemonic powers. And China went, you're missing the point. This isn't multipolarity. We're not interested in that. It's not happening. But, it might be a way where they can reach some sort of agreement. And that would obviously include the United States stopping, deciding that its new territory of conquest, in inverted commas, is Southeast Asia or the Asia Pacific. You might want to leave Taiwan alone finally and stop pretending you agree with the one China principle when in reality you don't, etc., etc. So, yes, I think ultimately something will have to happen, but I don't think China's going to go for a Plaza Accords, because we saw what that did to Japan, totally screwed them, and has ever since. So we'll see, but I think overall there is a recognition in the US that something huge has to change. And okay, it's very difficult as this hegemonic power that's no longer trying to still project like it has that power, which it doesn't, and making these changes. But it's in their interests, as difficult as this may be, to have cooperation with Russia, with China, for that matter, Iran, and a whole bunch of other nations, and going, well, it's what I call the United States trying to be a great nation amongst equals, which for many Americans is not acceptable, but that's the future, and just accepting that to be the new reality. So I think other thing, if you want to, you said to talk about the US Treasury market, kind of the current state of the curve, and some sort of observations in that regard, which ties in with all what we've discussed and what Besant's thinking is in this regard.
Yeah, just to be clear, when I said Plaza Accord, I didn't mean that the results will be as has been in Plaza Accord.
Oh no, I know.
I,
No.
I just meant that, it's a good time to gather and decide on critical issues, and the critical issues are, you know, relative currency levels, how much of each currency you need to buy a barrel of oil, who finances the expenditure, all those things, right?
Yeah, absolutely.
I don't know who will be part of that and what they're going to decide, but it's more of a kind of an idea rather than a replication of what has been. Yeah, so in terms of the U.S. Treasury markets, Besant keeps saying that the longer end of the curve is more important, and of course it is more important than the Fed funds rate, and of course it is because it's just used so widely in the economy for all sorts of things like mortgages, longer dated credit, all that stuff. The Fed can manipulate the short end of the curve through the Fed funds rate, but when it comes to the longer dated stuff, it's not following the Fed funds rate directly, right? And that's what we've seen in this cycle. They dropped the Fed funds rate, and 10-year went up, actually raising a question whether it actually stimulates or not, because again, things got more expensive on the longer end. And, it's, and I think it's a big reason why the Fed has stopped so abruptly. Well, politics is one thing, the election year, all that. But I think it was that the bigger reason was that the curve wasn't moving as they expected. And I'm pretty sure they thought that the totality of the curve would be going down. But then again, this problem of demand for the longer dated stuff or rather lack of demand, is a problem. And Besant seems to realize that it's critical. It obviously makes sense given his background. Like I said, despite all of this talk, for now, Treasury is sticking to Yellen's approach of terming out debt on the short side. Again, not because they want to, but because they have to, kind of thing. But I still think that the Treasury will do everything to bring the 10-year rate down. And like if you're honest about it, it's the only way to do this is through some form of yield curve control. So, and if you accept this as the strategy, then the only question that remains is who's going to be buying that 10-year debt. There's been some talk already about reductions in the SLR ratios, and I guess it will be the first push on the Treasury side to allow commercial banks to buy more. Same. I would assume the same would apply to, pension companies or insurance companies. They could be forced into buying a longer debt through regulation or deregulation, whatever you want to call it. The Treasury itself is doing buybacks. It's ridiculous, but they borrow with one hand and they lend with the other. It doesn't make any sense, but in terms of providing this marginal demand for the longer dated stuff, I guess it's valid. It seems to be working. Of course, you could try to force your economic partners into buying this debt as well. I think that one is a difficult one. You need to motivate these guys financially, economically, and I guess you could force Europe to do this. Well, with what money is another question, but say there is money, which there isn't. But you can't force China to do it. They've been rolling off their US debt since 2014, and they continue doing so. Problems in Japan that we've covered many times. Essentially, they lead to sales of US treasuries at the end of the day. So it's difficult to imagine how they would be buying So, this idea of coercing foreigners into buying that stuff is difficult to imagine. But again, if we have this get together and, it's part of the big deal, then maybe it could be worked out. Like, you bail me out, but you get this, that, the other kind of thing, and everyone does it. But I think this is the hardest variation of this demand. And then again, you always have the Fed that could come back to the QE policies. In the last meeting, they kind of hinted that QT, the quantitative tightening thing, is about to end. I think it ends within a couple of months, to be fair. And it's basically admitting that they'll have to buy their own debt, at least to a certain degree. I'm not sure if it's all of the debt, but you know. So there are ways to do this. Basically, that's my point. To buy that longer duration to get rates down, there are ways you could do it. There is any difference between the balances of commercial banks or the Fed itself, I don't think there is any difference. After all, the Fed is composed of the bigger commercial banks, so essentially it's the same thing. But yeah, I think they'll go with the SLR first, then try to find any type of demand, and then if that's not enough, the Fed will come in and buy up. This, of course, sounds all nice on paper, but in reality, it has huge implications for the cross rates. Dollar cross rates are likely to be influenced heavily by this approach. And given the raise in the debt ceiling and all these, continuations of tax decreases, I don't see any other way but to monetize, and the release wall for that is the dollar. It's always your currency. So, it's kind of where we had it. I think it is no coincidence that gold is, touching all-time highs. I think that's part of it. That's kind of the markets realizing that a lot of debt is coming our way, and the money mass will increase substantially. So a lot of changes. I think this year and next are going to be a bit of a roller coaster. That's my my expectation, at least.
Yeah, I would share your sentiment. I'll just add some points. I mean, I think one of the big fundamental things we know is gold's becoming much more in the minds of the world a reserve asset as opposed to the US Treasury, which is played havoc to some degree with US Treasury markets. I think the Bess and kind of Trump camp have made their position abundantly clear. And part of this does relate to the fact there's trillions of dollars of treasuries that need rolling over. So they'd like to see interest rates slashed. They want, and they won't admit it, QE again. They know it's coming, and without any shadow of a doubt. So from their perspective, it makes sense to have those policy decisions implemented. The Fed's going to go, excuse me, we're not comfortable with that idea. And I think even if you slashed interest rates, I will go out on a limb here and say, I don't think the 10 year is going to come down. I think they're going to really struggle. I agree they'll want yield curve control. But I think apart from this idea that, gold's a reserve asset and the US Treasury less so, I also think a lot of it is just this fear that there is going to be, I think, inflation. I think that a lot of that's what's behind what we're seeing with the 10 year, because you're absolutely right. It's totally contradictory to what the Fed expected. But also equally, if you look at raising interest rates, there was an expectation gold would be priced about $1,200 an ounce instead of 2,900. And that's precisely why, because the old model's failing. It's and something a different dynamic now applies. I do agree. I mean, I'm no fan of Yellen either, but they have no choice. And they do need to address long dated maturities, absolutely. But who's going to buy? Well, banks have been very reluctant to buy for a long period of time, and kind of bullying them into doing so at this point in time, again, is not what Wall Street wants to hear. And again, because Wall Street thinks, well, you can do what we want to do. We don't want you kind of pressuring us to do it. I would include pension companies, other financial institutions in that regard. And, you're absolutely right about the Treasury and the bizarre policy that's going on there. In terms of foreigners, there's no appetite for it. I mean, the Chinese are not going to suddenly decide, yeah, we want to buy US treasuries. It's just not a reality for them. So ultimately, because let's just say Besant's policy is, well, we have to get the pain of some sort of economic crash, for want of a better word. Well, ultimately we're going to have to drive interest rates down. We're going to need to borrow, in inverted commas, huge amounts of money. Who's going to actually buy all this? Well, look, in the end, we're just going to have to print to infinity, and we'll say, look, the economy collapsed or crashed, and it's all Biden's fault, and we need to do this. So they'll try and put enormous pressure on the Fed to slash interest rates, and don't think they quite have worked out what's going to happen to the Treasury markets as a result of this. But I think it's a bit of an act of desperation, and they got to find some way to restore confidence. And yet, one of the flip sides to this, it might have been Besant, or it might be wrong. Somebody basically inferred, well, we're going to have to get the yields to rise on the 10-year to encourage, I don't know, China to buy it, whatever. I mean,
so 20%.
Was it 20%? I mean, again,
that would motivate a lot of people.
Yeah, it might motivate
myself.
me. I mean,
yeah, exactly.
But to be honest, again, it's all contradictory. So you can't have the 10-year at 20% and then go, well, we're rolling over all this debt. And because then what happens to the interest bearing debt? I mean, it just grows exponentially. Again, you're just trying to fight the mathematical impossibility. So we'll see what happens.
The debt is too big for these rates. It's just too big.
Yeah, and that's hence why they largely tried the QE zero interest rate policy model, because that way they could print lots of money and it wasn't such an onerous problem, in inverted commas. Okay, it's not. Ultimately, it is, because they didn't understand that eventually interest rates were bound to rise, particularly in a sort of COVID world where the problem was no longer in Wall Street through financialization, where we saw all the inflation people pretended didn't exist or just didn't understand that it exists. And then it got out into Main Street for very obvious reasons. And then they started to lose control in inverted commas. So it's a huge challenge going forward. So I think on that basis, should we move on to the questions, unless you've got anything else, Paul?
Just a quick remark. It's amazing how these bad policies, like zero interest rates and the seeming irrelevance of deficits, how it impacts political thinking. I've had interactions with politicians a few times in my life, and I mean European politicians, right? Not US politicians. And when you start talking economics with them, they literally tell you, well, what's the problem? We'll just borrow some more money. And it's like a magic box which you open and there's this stash of cash all the time. That's like 10 years of this stuff, and they start thinking it's the normality, that it's normal. despite all of history saying that it is anything but normal. So, there's that part of it as well. We have a political class that doesn't understand the problem. So again, I think it's um, I think it's a good change that there is at least a push to address these problems. So that's definitely positive in my book. So yeah, that's it. That's the remark. Yeah, I would be happy to go through the questions.
Okay, let's start. I mean, they're in no particular order. I'm not going to put people's names. I'll just read them out. Someone's asked, how can we explain the gold silver ratio at 90 given historical ratio? And can you explain step by step the mechanism of PM manipulation, preferably with numbers? Well, frankly, that, all due respect, that's not possible. But to that degree of detail, but it says everyone keeps saying, but no one exactly with numbers. Well, yes, but that's obviously problematic. So that's the first question.
Yeah. Well, there's nothing to explain. It's the ratio. It is what it is. It's in a historical context. It's obviously mispriced. I think, correct me if I'm wrong, but I think the historical average for gold silver is like silver is 2.5% of whatever gold is. I think it's along those lines, and it's closer to 1% now. So, it's you could see silver as being cheap relative to gold. Same with oil, by the way. If you look at historical ratio of gold to oil, we are currently at levels that we saw only during COVID and those negative prices on the frontal contract. So similar dynamic there. I think for me, it's also an indication. I mean, the ratio, the gold silver ratio. To me, it's also an indication that gold has not reached its medium term peak, because in every peak previously, especially when it was when the run up was on the back of increase in money supply, the ratio was in a different place. So much lower, much lower. And for me, it's one of the things I look at trying to judge, where we are in the cycle. But having said this, you have to remember that silver and gold are different. Gold is a monetary currency. That's why the central banks store it and why it's been around as this medium of exchange for thousands of years. Silver is only partially monetary due to its industrial usage. So I would say they're not directly comparable. They're similar, but not directly comparable. But again, it seems to be mispriced historically, and I wouldn't be surprised if silver started outperforming gold at some point in this cycle, if you go by history at least.
Yeah, I would share your sentiments. I mean, yeah, the ratio for me is ridiculously high. It should be a lot lower. It doesn't really matter. Maybe 30 to 1, maybe even 25 to 1. Does that mean, it's a reality though? Because I mean, silver is predominantly an industrial metal and will continue to grow in terms of the demand for industrial application. It is partially monetary as far as retail investors is, but I mean, you're absolutely right. Central banks hold gold, they don't hold silver for very obvious reasons. In terms of manipulation, well, these are long held stories and they're a reality. We see things happening from time to time for sure. And there's a lot of theory surrounding it, but I don't get into the speculation. I could sit here for 2 hours speculating on all the things I've heard over the years. But for me, I do think that ratio will change. We don't do price predictions, and it's probably worth a good point to mention. Everything we're discussing today is for educational purposes. It's not financial advice in any way, shape, or form. So that includes the fact we're not here to make price predictions, because For me, it's rather reckless to do so, and history's proven, as I've made the point since 2013, that you won't see true price discovery until the West effectively is drained of gold. And that doesn't literally mean drained of gold, but I'm not going to get into that because I've said that so many times elsewhere. So let's move on to the next question. It says European stocks are rising whilst the economy is in decline. When do you expect stock markets will also decline? And are there particular reasons why there is this discrepancy?
Yeah. Well, I don't expect European stocks to decline. We hold a bunch of them in, auto sector, energy sector, etc. I think one thing that is very important is to understand that even at these valuations, with DAX at all-time highs or close to that, EU stocks are still relatively cheap compared to US. And, about 70% of total global market cap is in US stocks right now. So, if you believe in an uptrend and this kind of multipolar approach in the world globally, there could be a lot of catching up to do. I think it's wrong to equate the performance of stock markets to economies. It used to be this way, but it doesn't work this way in a financialized economy. You could theoretically have a collapsing GDP and enough liquidity injections and to keep the stock market going up. So to me, it's not a direct kind of comparison. I think another reason why we're seeing this is because, indices like DAX, for instance, they're heavily skewed to technology stocks and global businesses that weren't affected by energy issues in Germany. So, guys like SAP, Siemens, Allianz, luxury companies, they didn't suffer. Only the guys that produce locally, most of their stuff were affected. But if you look at the names in DAX, you'll see that these are global companies. I think, again, not to give an advice, you have to do your own kind of research. But to me, autos look relatively cheap. So, the big guys like BMW, Daimler, they look decent. They look kind of underpriced to me. So that's the difference. I think it's a big mistake to equate economic activity to stock markets in current situation. If American stock market falls, well, maybe it drags other guys with it. But our approach is such that we try to buy companies that are reasonably priced, better underpriced on some objective metrics. And then if something goes bad and the general market declines, these companies that we hold, we're happy to add on declines because they were, it's basic logic, they were priced attractively before. So if nothing materially has changed, then they're just more attractive. But that's our approach. I mean, it's not for everyone. We have a very long-term view on things. So years, To give you an example, you know this, Paul, but we've been buying Chinese stocks all the way through its recent decline, and it took us maybe a year and a half just to accumulate what we wanted, because the prices were coming down. So it's a long-term approach. We're not really traders per se.
You still there, Paul?
Yeah.
Yeah, sorry, I glitched momentarily. Not to worry. Yeah, I mean, yes, I agree with you. We have to take the adage that financialization changed. I don't agree with it. I agree with the sentiment that if you compare stocks to economic reality, they don't make sense. but the markets don't operate that way. But what I would say, from this is just my perspective, I think at some point the market will recognize economic reality. I don't know when that's going to be. And then I think we're going to see what I would call a return to the mean between what the economy really is and what stocks should be valued. And it should be on an individual basis. Yeah, I know markets get hammered like we saw in 2008. But in a broad sense, companies that have solid fundamentals should survive and will survive. Okay, and as Paul says, if you take a very short-term perspective, that's very different from having a more long-term perspective. But again, that's just an observation. It's not me telling people to invest in anything in any way, shape, or form. So I think the next question relates to what we've already kind of discussed about treasury markets, saying what are best solutions to face the large amounts of debt to roll over in 2025 because the amount's huge and too much was issued in the short term by Yellen. Well, I think, to be honest, we've already answered that question in the earlier segment. So I don't, from my perspective, think there's anything else to add to that.
No, we covered this for sure. Well, I mean, Yellen is not a complete idiot. She understood that borrowing for longer at lower rates is preferential. I mean, any sane human being understands that. She couldn't do this because of the reality of situation, all these inflows into the economy because of COVID, all these subsidies and PPP loans, all that stuff, the structure of it, but mainly because the demand it was not there for the kind of issuance they had to do. I mean, they did a lot of issuance, and it's not like these countries have money just lying around waiting for Americans to do helicopter money. They've got their own business, right? So yeah, but generally I think we've covered it, and I think I think they'll start off with commercial banks and then gradually move to the Fed itself. I guess the Bitcoin thing, the crypto reserve thing, is kind of related to U.S. Treasuries as well, because you have all these Tether and all these stable coins that are supposedly holding U.S. Treasuries. Well, they are holding, I'm guessing. Um, so that's another attempt to stimulate demand for the long-dated U.S. Treasuries. Whether it will work or not, well, I don't know. I highly doubt it. And even if it does, well, is it going to be enough? I'm not sure.
Yeah, absolutely. So another question, this is just generally reading balance sheets because someone said it means nothing. We have no idea what assets are actually there. It just shows market value. Can we identify which banks are most exposed to bad credit, shorting gold, etc., etc.?
Hmm. Yeah. So looking at balance sheet is a bit like looking in the rearview mirror. You're literally looking at past periods. But in today's world, companies are legally required to provide guidance every time they do these reports. Analysts are not dumb. Well, some of them are not dumb. So they try to make these educated guesses of where the revenue of the company is going or the debt situation of the company is going. I would say banks in particular are pretty opaque. I worked in a few. I think you did as well, Paul. So
Yes.
it's pretty easy to play with the balance sheet and make it look better. So for me, banks, the problem with banks is that pretty much because you only know the problem and once it's there for everyone to see. Actually, European banks look decent right now. Interest rates are where they should be for banks, and going in the right direction. Most of them pay dividends. They're fairly priced on metrics like PE or estimate PE. But we're not buying into them. In fact, we're closing out those positions precisely because they're not completely transparent. So I guess the answer is it means something, but it doesn't mean everything. Reading the balance sheet, you still have to look at it, and you like the trick is to understand that what you're seeing is the past and trying your best to project the future of this particular company. Banks are notoriously opaque.
Yeah, absolutely. I'd share that sentiment. The only thing I could add to that is you need to be very good at almost forensic accounting to potentially find something in a balance sheet that doesn't add up. I've seen things mentioning no names in since 2008 at times going, hang on, this doesn't make sense. But even then, it's not absolutely clear that that is the case. But so it is very, very difficult to make those assertions precisely because they're not opaque. Well, they're not, sorry, not transparent. Okay, this
Yeah.
kind of ties in with the previous question. Can you explain the likely trajectory of European economies? Are we talking slow disintegration? Can it even be reversed? Well, I guess this all relates to the fact Europe's in big trouble because it needs cheap energy and it doesn't have access to cheap energy. And that's not the whole problem, but energy is the lifeblood of a nation. And if your energy costs are 5 times higher or 3 or 4 or whatever it is, then you're going to have serious problems. So without addressing that problem, then then the trajectory is very poor for European economies and also the sanctions problems. Just a small point I can make: Finland's economy is in serious trouble. Why? To some extent or a large extent, doesn't trade with the Russia anymore, and also not Russian tourists and people going over the border and spending money in Finland as one example. It's not the entire story, but can it be reversed? Well, at some point it'll have to be, but that's not a short-term problem for me. That's a far more nuanced long-term problem, and part of that is just accepting the reality that without cheap Russian energy or something equating to that, then Europe's problems are only going to grow and manifest themselves. And it's not everything because there are other fundamental long-term problems. But slow disintegration, well, something can be slow and then suddenly it becomes very fast. And but the trajectory in Germany is a great example where there's huge problems probably happen relatively quickly.
Hmm. Yeah, look, I'm an eternal optimist. Uh, I think Europe is a great place, and it has everything required to succeed. Our problem is not Europe. Our problem is the current geopolitical setup that leads to the kind of leaders and decision makers that we have today. That's the real problem. I believe in evolution. I've mentioned this a lot of times, I think, in our conversations with you, online and offline. So current system must and will give way to a new and better one. And I think we're at the crossroads right now, and I think current changes will lead to a better and stronger Europe in the end. Like I said, an eternal optimist. Can EU disintegrate? Yes, theoretically, we have seen many unions blow up and change throughout history, but I would say that it's a very expensive proposition and a very backwards proposition, at least when we're talking about EMU, the currency union. So, any country that leaves the union and establishes its own currency is basically left with euro-denominated debt. And the chances are your little currency will devalue against whatever remains of the MU block or the dollar or, yuan or whatever. So it makes this a lose-lose proposition financially. It also makes you less competitive generally. I guess the reason why UK could leave the EU was because they never gave up on the pound. They had and still have their own independent central bank, etc. So by extension, the only countries that could theoretically leave are Scandinavian countries, Czech Republic, Slovakia, Hungary, Poland, but not the big ones. And it's the big ones that really matter at the end of the day. We all know Germany is the powerhouse, right? France is pretty big, etc. So none of the smaller countries can be productive and efficient if EU is not trading with them, right? So it's very difficult for me to believe we'll get there, but anything could happen. I think the idea of a common market is actually pretty good and forward thinking. It's just been mismanaged, also through external influence for literally decades. Once this changes, things will heal, and I'm pretty sure it's changing.
Yeah, ultimately, yeah, Europe as a model will have to change. I don't see the end of the European Union per se, but it has to go through radical reform and change, and that's a whole separate subject for another day. The next question is, can you share your thoughts on Hong Kong and the Hong Kong dollar US dollar peg? Is Beijing going to depeg and devalue the Hong Kong dollar against the RMB? And is Beijing going to crash the Hong Kong property market? Well, like mainland, well, they didn't crash the market mainland. But anyway, to make Hong Kong more livable, and, does Beijing have any timeline? Obviously, if indeed this is the case.
Yeah, they have a timeline. It's 2000 years for whatever policy they have. Uh, yeah, look, Hong Kong is a special place. It's not that big. So, a lot of money is chasing these square meters. That's why it's so expensive, not because, people are speculating. It's just, it's China's financial center. So obviously it attracts very wealthy people that have no problem paying rent or buying houses or flats, which leaves your average guy wondering how to afford it. But it's a very special place in that sense. So no, I don't think they'll force prices down in real estate. It's also an autonomy, so they kind of come up with their own rules, at least when it comes to housing. I'm sure they control it themselves. So the peg, so dollar, Hong Kong dollar peg, I think it stays the way it is right now. I don't think they'll depeg. A lot of money, a lot of dumb money was burned over the years betting on this depeg thing. And it's always the same story. China's bad, China's stupid, they'll have to do it, and it never happens. So I think China controls the totality of money mass in Hong Kong. If you look at interest rates in Hong Kong dollar, they're matched to those in the US pretty much straight away. I guess it could happen, but there needs to be a reason for that. And I guess it could happen only if China sees real economic trouble, which it does not right now. Not at all, I would say. So dollar against Hong Kong dollar is basically a dollar proxy for foreigners that China controls in every way possible. It's basically for guys that have difficulty with access to yuan or yuan denominated assets. For instance, in Europe, it's pretty difficult to get access to that. And for guys who want to invest in China but don't want to take on the dollar yuan FX risk, which is very real, dollar yuan has been pretty stable over the last couple of decades, but still, if you want to eliminate this risk altogether, you just buy Hong Kong dollar, and say you buy some stocks in Hong Kong dollar, and this way, China controls the exchange, and it can't be blocked by a decree of U.S. president, for instance. So the stuff that happened to Russian assets can't happen to this, basically, because they control the exchange themselves. So in terms of repricing of currency pairs, I think the bigger impact could be achieved through manipulation of dollar yuan or euro yuan, because it is yuan that is the trading currency. It's not the Hong Kong dollar. Hong Kong dollar is an investment currency. It's again for guys who want to invest in China but don't want this FX risk, maybe or maybe someone who wants to leave out this risk altogether. Yeah, so just to touch a little bit on dollar yuan, it's been remarkably stable over the past couple of decades. It's literally at the same level as 2008 today. So, 20 years of extreme stability. And it's no wonder that China's trading partners are happy to use yuan in trade because of that. I kind of think it will stay the same. I don't buy the yuan devaluation story at all. I mean, if you follow me on Twitter, that's the case. I just laugh it off every time someone comes up with it. I don't think it makes sense to anyone, not even the U.S., because if yuan goes lower, it just makes the problem of trade deficit with China even worse. They'll make more money rather than less money. So I think it's a bit of a scarecrow kind of thing. I don't buy it. So no depeg and no devaluation of yuan, I don't think.
I can't add anything to that. I would agree in totality. So the next question we've already answered. So, I mean, I can probably just make a very simple statement. This is how do you explain Germany's economy in the dumpster, but the DAX at record highs? Well, this is financialization, where the two don't marry up and haven't done for principally since not entirely, but to a large extent since 2008, but it was at times prior to that also. And it's as simple as that. It's because financialization is always about having asset appreciation. It's the only way the system works. If assets start collapsing or falling sharply, then you've got big problems. So for me, that's the simple answer. And it is a simple answer, but it reflects the reality of why things are the way they are. I don't agree with it. I think it's idiotic. And but that's the way it is, and that's why you see this huge discrepancy.
Yeah.
Okay, so a few more. I think we'll tie two of these questions together, and you kind of already sort of answered it partially anyway, which the Treasury and Trump do they have the authority to create this crypto reserve? Trump came out with, was it yesterday? Yeah. And does that have to go through Congress? And someone else makes a really exactly the point. Is this crypto reserve just a mechanism to generate treasury paper demand because of stable coins, which in principle have to back the coins with treasury? So I'll combine those two questions into one.
Yeah. So the authority part. I think the president has the power to issue an executive order to establish the reserve. It basically says we need this thing, and there's nothing stopping him from doing that. But then I'm guessing here, I don't know, because it's a pretty new thing, so it's probably not defined clearly. Because it's just never been the case before. But I guess once the executive order is signed, then it's down to technicalities that should be established by broader government, meaning the Congress, or at least some branch of the government. So, given that crypto is kind of a financial asset, I'm guessing it will be down to the Treasury. The big question is not establishing the reserve, because theoretically, U.S. could just keep the crypto assets that they seize in catching criminals and getting access to their assets, just not sell them. So that would kind of lead to a reserve pile. But if they intend to buy, then basically two questions arise: how much are they going to buy? And that's if you are involved in the crypto industry, that's the critical question, right? Because the only that would influence the prices of crypto assets, not seizing it from criminals, right? And the second question, which is probably more important, is how they're going to finance these purchases, because you establish these wealth funds or reserves when you have ample surpluses, right? When you make money in trade, or when your tax receipts exceed your expenditure. This is not the case for US right now, so um, you know, are they going to print this money? Are they going to increase the deficit to accommodate for these purchases? How much is it going to be? These are the real questions, not whether Congress will, push it through. Um, and I think the whole debate in Congress will be about, whether it, increases expenditure or increases the deficits, or all these things. So I think it's very telling that they keep talking about it but don't provide the details. It's because it's one thing just to say it and sign an executive order, and it's quite another to actually execute this. I would also say that this crypto reserve thing is a clear political risk for Trump as well, because this whole idea that you can use this industry to stimulate demand for treasuries rests on the idea that the total market cap of crypto keeps going up. And for that, you need to be buying, and for that, you need to be printing. So why not just print and buy US Treasury straight away? Why do you have to go through this conduit of crypto? Doesn't make sense. I guess the idea is to make it attractive for the global world, for other central banks or something like that, and then it grows organically, and there's extra demand for treasuries. But I just don't see it happening, really. I just don't see China choosing Bitcoin over oil or silver or gold. It just doesn't make sense. So they probably won't do it. But in terms of authority, yeah, the president can come up with any idea. Whether it gets passed or adjusted is another story. And since it's such a new thing, it's very unclear right now.
Yeah, absolutely. I think it's fraught with huge problems. For me, ultimately, it's a gigantic dumpster fire that's going to, if it ever takes off, it will be a disaster. And I'm happy.
He's Trump is not talking about Trump coin anymore, right?
No,
Or Melania
just
coin.
I just don't. It's not a reality for me in the long term. If you want a sovereign wealth fund, then you know take the Norwegian model. But yeah, absolutely, you have to be running trade surpluses, and in the Norwegian case, selling huge amounts of energy the world wanted and putting the profits into a sovereign wealth fund. That okay, you have to make the right
Same
decision.
with Saudis, right? Same thing.
Yes,
Same with
yes, exactly.
Russians.
So, just the final question. Uh, says, given the complete mess in the Western Hemisphere, which countries would you point to as shining examples of sound and pragmatic economic policies for development and prosperity?
Yeah. Um, I don't like the term shining example. I'm not sure what that means. I think, like, if you're objective and look at achievements over the past 20 years, I guess you can't really avoid but saying it's China. because their transformation is nothing short of incredible. Like I've been following China for a long time, literally all of my time in the marketplace, which is 20 years plus. And, it was always presented as this backwards economy, communist, central planning, everything's wrong kind of thing in the West. And it was always shown with this disdain kind of thing. And if you look at the reality of what has happened, it's just amazing in terms of technology, in terms of manufacturing, in terms of what they've done with their ports, in terms of their ideology of how they deal with the rest of the world in a positive and economically beneficial fashion. I think their model is a good example for everyone, really. The fact that they call themselves communist, I think you have to dig a little bit deeper than the name. And I was born in the USSR, right? So I have some framework of comparison. And China is nothing, today's China is nothing like late USSR. It's actually the opposite of that. You can be communist in different ways, I guess. And as China's example shows us, it can be a very positive way, right? So yeah, I would say China. You could look at places like Indonesia. I think Indonesia is interesting. It's a big place, a lot of people. They've been doing well. But if you had to choose one, I would choose China, I think.
Yeah, absolutely. I know China very well. I've worked there. I've been there many times. I mean, for me, and I've said this before, their development in the last 25 years is nothing short of sensational. It's quite breathtaking, and yeah, China's not communist. It's anything but communist. That's one of the big myths in the West, along with many others. I think for me, what's interesting, you mentioned Indonesia, and that's a good example. It's the so-called emerging market countries, which a lot of them aren't emerging markets. We have emerging market type economies now in the West in many senses. And they're the countries of the future. I think in the next 10, 20, 30 years, we're going to see many of these economies start to become examples of how economies should be run in the future. It's not going to be a straight line. There's going to be successes and failures, but it's picking out those economies that I think will succeed. I think there will be a lot of them. And okay, you can always extrapolate to ridiculous timelines, which become rather meaningless. But I think for me, that's as interesting as reflecting upon countries that like China, who for me stands head and shoulders over any other country. Ask me in 10, 20 years, and I'll probably give you a list of quite a few other countries who, in this period coming, have evolved and extremely well. And I think there will be more and more as multipolarity takes hold, and unipolarity is, well, it's dead anyway. Just no one's kind of in the West is really understands that, but they will in the fullness of time. I think then you'll see more and more countries that kind of fulfill this sort of criteria. So I think that's my perspective on this. So
Yeah.
that's all the questions. So I think that's probably a good point to stop. So unless you've got anything else.
We took our time, right?
Yeah, well, and I think, that's because people ask questions. I think you have to give the right answers and not just some flippant remarks. So unless
Yeah.
you've got anything else to add, Paul, I think that's a good point to stop.
No, I just wanted to say thank you again, and thanks to anyone who's listening. I'm happy to engage with anyone who's decent and nice to me on Twitter. So go ahead and engage me.
Yeah, and obviously, thanks for joining today, Paul. It's always a pleasure when we do these kind of chats. I think I don't like the word interview; sounds a bit ridiculous.
It's not though.
No, it's
It's
not,
not
and
an
it
interview.
shouldn't be. I
It
think these
shouldn't be,
kind of
no.
discussions. So, and obviously to everyone who's listening and all the questions, thank you very much. We appreciate that. So,
Thank you.
obviously, just a final point again. This is not financial investment advice. It's just educational. Do your own research. Go and consult with your own independent financial advisors on with respect to what we've discussed. And obviously, again, Paul, thanks. It's always a pleasure. It's great when we catch up for just a chat between ourselves and also in this environment. And obviously, in a broader sense, please like, share, subscribe, spread the news. We're trying to grow the channel because, as I painstakingly say far too much, I admit, it's a channel to inform people and not entertain people. And that's what people need never now more than any other point.
Especially now.
Yeah,
Especially now.
especially now. Yeah.
I agree completely, and thank you as well.
Yes, and we'll be doing this again soon. And with
Definitely.
that, I will say if I can find the button to end it, because I'm
Yes, you can.
stuck in a load of windows. Right. Okay. Thanks again, Paul, and we'll catch
Thank you.
everyone soon. And with that, I'll say goodbye.